The 4% rule promised financial independence for decades. It guaranteed a 30-year retirement success rate. That promise is now mathematically broken. Current market conditions invalidate the original Trinity Study findings. High inflation erodes purchasing power faster than anticipated. Bond yields remain historically suppressed. A 4% withdrawal rate today carries significant failure risk. Retirees must adjust their expectations immediately. The new Safe Withdrawal Rate is closer to 3.3%. This requires substantially larger retirement portfolios. We will detail the exact calculations and necessary portfolio shifts. Ignoring this change risks running out of money prematurely. The 4% rule originated from the 1998 Trinity Study. Researchers analyzed historical market data from 1926 to 1995. The study focused on portfolio longevity over 30 years. It assumed a fixed withdrawal amount adjusted annually for inflation. The original model used a balanced portfolio structure. Typically, this meant 50% stocks and 50% bonds. Success was defined as the portfolio lasting the full 30-year period. The 4% rate achieved a near 95% success rate historically. This success relied heavily on high real returns in the 20th century. The current low interest rate environment is the primary failure point. Treasury yields are significantly lower than the historical average. Low bond returns cannot buffer equity downturns effectively. Sequence of returns risk is amplified during early retirement years. A major market crash early on devastates a 4% withdrawal plan. The original study did not account for prolonged periods of high inflation volatility. Modern inflation spikes require higher nominal withdrawals quickly. This combination drastically reduces the probability of portfolio survival. Recent research confirms the necessary reduction in the withdrawal rate. Morningstar suggests a 3.3% rate for a 90% success probability. Other models push the rate down to 3.0% for maximum safety. This lower rate accounts for current valuation metrics. High price-to-earnings ratio suggests lower future equity returns. The required portfolio size increases by 20 to 33% instantly. For example, a $1 million portfolio now supports $33,000 annually. This is a critical adjustment for anyone planning retirement today. The traditional 50-50 portfolio is insufficient for modern SWR goals. Retirees must increase equity exposure to capture growth. A 70% stock and 30% bond allocation is now common. This higher equity weighting introduces greater volatility risk. Alternative investments can provide necessary diversification. Real estate investment trusts or commodities offer inflation protection. Treasury Inflation-Protected Securities are essential for mitigating inflation risk. Rebalancing frequency also impacts portfolio longevity significantly. Fixed withdrawal rates ignore actual market performance. Dynamic strategies adjust withdrawals based on portfolio value. The Guardrails approach is a popular dynamic method. It sets upper and lower limits for annual spending adjustments. If the portfolio performs exceptionally well, withdrawals increase slightly. If the portfolio drops significantly, withdrawals are temporarily reduced. This flexibility greatly improves the portfolio's survival probability. It mitigates the devastating impact of sequence of returns risk. The order of asset liquidation impacts tax liability and longevity. Taxable brokerage accounts should generally be withdrawn first. This allows tax-advantaged accounts more time to compound. Roth accounts should be preserved until the very end of retirement. Roth withdrawals are tax-free and provide maximum flexibility later. Traditional IRA or 401k withdrawals are mandatory after age 73. Required minimum distributions must be factored into the withdrawal plan. Strategic tax planning minimizes the overall tax drag on the portfolio. Legal structures influence access and protection of retirement funds. Trusts can shield assets from potential legal judgments. Revocable living trusts maintain control while simplifying estate transfer. Beneficiary designations override provisions in a standard will. Spousal rights must be considered for qualified retirement plans. Understanding state laws regarding creditor protection is vital. These legal safeguards ensure the intended distribution of remaining wealth.